Hello, welcome everybody to today's presentation on advanced 1031 exchange strategies. My name is Jeff Stechmann. I'm the business development manager for Asset Exchange Company. Before we kind of get started, just want to kind of let you guys know how we're going to handle today's presentation. Don't feel like you have to write every single thing down. The presentation today is being recorded, and you will receive a link to today's recording if you want to refer back to any of the topics that we talk about. And then also, some of the various topics that we're going to cover today, I have in a PDF form. I'm going to email those out to you guys. That way you'll have them at your disposal. I find a lot of times if you do have a client, if you're a realtor and you have a client that has a 1031 exchange need, you really would love to have something to forward on to them. So this will be perfect for you. Some of the literature that I have, it is available in Spanish and also Chinese. If you'd like to have it in the various additional languages, please just shoot me an email. My contact information's up on the screen, and I'll post it again at the very end. And then also, as far as questions go, I'll open the floor up to questions at the very end of the presentation because, I find a lot of times if you do have a question, most often it'll be covered in an upcoming slide. But if for some reason it's not, then hey, again at the end we'll open the floor up to questions. On the right-hand side of your screen is a box that says questions. Right there is where you'd want to type them in. But again, I'll mention that at the very end. So it looks like we had a few people join a few minutes late. So again, my name's Jeff Stechmann, Business Development Manager for Asset Exchange Company. Kind of give y'all some information about myself. I've actually been in the business for 25 years. I did a lot on the title side of the business to get my start. I'm originally from New Orleans, so if you hear the accent come through, please forgive me. Every now and then it it rears its ugly head. But I've actually lived in Tampa, Florida, for 22 out of those 25 years. And as long as I've been doing this, it's I've seen the really good times in the real estate industry, and boy, I've seen the really bad times. And hopefully we just never have to see those bad times again. Right now, the real estate industry is really exploding. Everybody that I talk to, and I talk to people up and down the eastern United States, the east coast of the United States, and it's just everywhere. It's not just here in Florida, but everywhere in the country, at least as far as I know. Things are really, really busy for everyone, which is great news. Now, let me give you all some information about the company. So we've actually been in business since 2006. And over the course of our existence, we've done about 35,000 1031 exchanges. So, it's all that we do. We don't provide any type of closing services. We don't provide any type of financial services. In the industry, we're known as a qualified intermediary, QI for short. Now, depending on the part of the country that you live in, other terms you may hear people refer to is an accommodator. Another term is a facilitator, or just simply an intermediary. But in my neck of the woods, people just call us QIs. And, our main job in a 1031 exchange is we actually hold the proceeds from what we refer to as the relinquished property. So that's the property being sold in a 1031 exchange. Well, we hold the proceeds from that sale because the rule is they can never actually have receipt of the funds, the seller, the exchanger. If they do, they lose their ability to do a 1031 exchange. And we're going to talk about that in more details in the next few minutes. Now, word of caution about QIs. It's amazing in today's heavily regulated real estate industry that, at least on a federal level, there actually is no federal agency that oversees what we do. So what exactly does that mean, right? Well, what that means is there's no type of requirement you have to have any type of E&O insurance. There's no type of requirement you have to have any type of bond. There's no guidelines on where you hold the proceeds. There's no guidelines on the type of funds you hold the proceeds in. It's a really scary, scary thought when you think about it. So if anybody on the line today is currently involved with a 1031 exchange, please just make sure you do your due diligence and you're dealing with a reputable company. Now, the great news when you deal with us is we're actually based out of California. Our home office is in San Francisco. And because we're based out of California, well, the state of California actually has a state agency referred to as the California Franchise Tax Board. Now, that franchise tax board actually oversees qualified intermediaries in the state of California. They do require us to carry minimums for the E&O insurance we have, minimums for the bond that we carry. There's guidelines on the financial institutions where we hold the proceeds, the type of funds we hold the proceeds in. We're subject to audit by that franchise tax board, which is great for anybody that deals with us in California, right? But anything that we do nationwide, because we do 1031 exchanges all over the country in multiple states, right? That franchise tax board has oversight in anything that we do, any file that we work on, any exchange that we work on, because, as I mentioned, they can come into our office and audit any of the files that we do, all right? Any of the files that we any exchanges that we work on. So great news when you deal with us. Now, as far as our ownership goes, we're actually owned by two gentlemen. Now, they've been in the 1031 exchange business specifically for 20 plus years, one of which is actually a tax attorney. Now, his name is Adam Skarsgård. Now, Adam is actually considered like a 1031 exchange expert. He's been called upon to testify in tax court as an expert witness on 1031 exchange. He even occasionally teaches at UC Berkeley on real estate and tax law, that type of thing. The whole reason I like to bring his name up is because, one of the things that we offer that I don't know any other QI in the business offers is any of the exchanges that we're involved with, if for some reason they were to get audited by the IRS, well, we would actually provide free audit support. All right, we'd work hand in hand with the client's CPA helping to defend the audit, and it primarily would be done by our tax attorney, Adam Skarsgård. So another great reason to deal with us. Now, let's talk a little bit about why investors exchange. So, the single most obvious reason that we see is for tax deferment. So, typically when you sell real property, if you have any gain in the property, on average, about a third of whatever that gain is goes towards paying taxes. So that's the single most reason that we see people, investors doing 1031 exchanges, is to defer those taxes. But what are some of the other things that we see? Well, the next point, I call it buy more property. So with exchanging, the replacement property that gets purchased in a 1031 exchange, right? The purchase price of that property must be equal to or greater than whatever the sales price was on the property that was sold, the relinquished property. So what an investor will do is they utilize the tax savings by doing a 1031 exchange. They utilize that savings to leverage it into being able to go out and buy a better property. Right? Hopefully it's a higher dollar property, and hopefully it's going to be a higher income producing property by doing the benefits of not having to cut that check when they do a 1031 exchange, right? What are some of the other things that we see? Well, diversification and management relief is another thing that we see. With 1031 exchange, you're not even limited on how many properties you can sell in an exchange. You're not limited to how many properties you can even purchase as your replacement properties in exchange. You could sell one property, you could buy one, you could sell one, you could buy multiple properties. You could sell multiple properties in a 1031 exchange and purchase a single property or purchase multiple. It doesn't matter. What matters? We covered this in the basics class last week, but what matters in 1031 exchange is whatever you're selling, right, you have to be using that real property in your trade or business, or you have to be holding it for investment. And what you're replacing it with, you have to use that real property in your trade or business, or you're holding it for investment. It's referred to as like-kind property, right? It can be any type of real property. It doesn't matter if it's commercial or residential. It's all interchangeable. The only thing that matters is what? As long as what you're selling, you're using it in your trade or business, or you're holding it for investment. And as long as what you're replacing it with like-kind property, which is what? Any type of real property that you use in your trade or business or that you hold for investment, all right? And those properties can be located where? Anywhere in the United States, including Guam or the U.S. Virgin Islands, right? So geographic diversification is something that we see all the time. I'll give you guys an example. We did an exchange for a gentleman that he was selling property in California. All right, so let's say you sell property in California. All right, you have an investment property, right, a rental property. Now, when you do the 1031 exchange, right, you defer your taxes, right? But instead of buying a replacement property in California, you say, well, maybe I'll buy one replacement property somewhere here in Florida. Maybe I'll buy a second replacement property, maybe somewhere in Texas. And I don't know, maybe I'll even buy a third replacement property somewhere in, say, maybe Ohio. Because why? Because you don't want to be so geographically tied in to one particular real estate market. Because, hey, if our market here in Florida starts to go down again, well, at least you have that other property in Texas and you have that additional property in Ohio. Hopefully those markets, those real estate markets, would not be experiencing the same downturn that we would be experiencing here in Florida. So geographic diversification is something that we see. Management relief is another is something else that we see. Give you guys another example. I have a guy that lives in New York, right? He owns 4 rental properties. Now, what he would like to do is he'd like to sell all 4 of those rental properties in one 1031 exchange, all right? And he'd like to retire and he'd move to Florida. But you know what? He doesn't want to manage property anymore. So what he'd like to do when he'd like to find for his replacement property, maybe like a small apartment complex that has some on-site management. Because why? Because again, he doesn't want to worry about managing property anymore. He wants to retire, and he wants to just basically collect a check every month. So 1031 exchange is perfect for somebody like him because he's seeking that management relief. All right. Now, another thing with 1031 exchange is that, it doesn't get talked about that often, but investors will actually use 1031 exchange as an estate planning tool. All right. So with exchanging, you're not even limited to how many times you can do a 1031 exchange. All right. I could buy a property today, right? I could buy an investment property, say a rental property today, hold on to that property for a period of years, at some point sell it, do a 1031 exchange, defer my taxes, buy another investment property, right? I could hold on to that for a period of years, at some point sell that, do another 1031 exchange, defer my taxes again, and buy another investment property. And I can keep doing that over and over and over the entire course of my lifetime. Okay, now, when I pass on, when I die, right, if I have any heirs that inherit my property, they're going to get what's referred to as a step up in basis, right? And what basically that means is whatever the value of the property is when they inherit it, that's their basis, right? All of those deferrals that I would have done over the course of my lifetime, basically they go away and no one ever has to pay the taxes, right? It's a really good deal, right? Especially for people that live here in Florida that retire here and live out the rest of their years. Now, the flip side of that, all right, I just said, hey, you're not limited to how many times you can do a 1031 exchange, right? Buy a property today, hold on to it for a period of years, sell it into 1031, buy another replacement property, investment property, hold on to that for a period of years, do another 1031 exchange, defer your taxes again, and buy another investment property. But let's just say the next time you go to sell, you say, you know what? I don't want to do another 1031 exchange. I don't want to buy any investment property. I'm just going to sell my property and cash out and pay whatever taxes are due. Well, you're going to be subject to paying the taxes on that particular sale, and all of those deferrals that you did over the course of your lifetime, you also are going to be subject to having to pay those taxes as well. All right, because with 1031 exchange, it's not a tax avoidance, okay? It's a tax deferral. Deferral meaning that, hey, you may have to pay the taxes someday, but what? If you have heirs that inherit your property, all right, they're going to get that step up in basis, and hopefully no one ever is going to have to pay those taxes, all right, because they're not responsible for it, and all those deferrals that you would have done over the course of your lifetime, they go away. All right. So I want everybody to remember the whole estate planning, the step up in basis, because it's a really great aspect of 1031 exchange that it doesn't really get talked about that often. All right. And for those of y'all that are located here in Florida, we have so many retirees that move here. It's perfect for a retiree, especially if they own investment property in another part of the country. They can sell it, they can move here, they can buy some new investment property, and they can do a 1031 exchange and defer all their taxes. Right? I'll give you guys another example of how the step up in basis could work as an heir. All right, let's just say I'm the heir. Right? I inherit the property. Now, it's a rental property, right? So I may be looking at it and say, gosh, this is a great property. It has some nice cash flow coming in every month. You know what? I'm going to hold on to it for my investment purposes. So let's say I hold on to that rental property, that investment property for a period of years. I don't know. Let's just say I hold on to it for 5 years. All right. Now, after 5 years, maybe I say, okay, now I'm ready to sell the property. So if I have any gain from when I inherited the property to when I go to sell it 5 years later, guess what? I can do my own 1031 exchange and defer my taxes and basically start the whole process over again. All right. So everybody, remember the thing with the step up in basis, the estate planning. Again, it's a really great aspect of 1031 exchange. All right. Now, let's talk about a little bit about what current tax rates are. So when you sell real property, right, if you have any gain in the property, you're going to be subject to capital gains taxes. Now, capital gains taxes right now are either 15% or 20%. All right. The 15% historically was applied if you were single and you had income of less than $400,000 a year, or if you were married and you had income of less than $450,000 a year. That's where you were at the 15% capital gains tax rates. Now, the 20% capital gains tax rate typically, historically, was applied if you were single and your income of greater than $400,000 a year, or if you were married and you had income of greater than $450,000 a year. That's where you were at the 20% capital gains tax rate. Now, I think the income levels have risen just a bit with the last tax reform bill. But any way you look at it, you're still going to be looking at either 15 or 20% capital gains tax rates, right? When you sell that real property and you have any gains. Now, on top of that, you also are going to be subject to what they refer to as depreciation recapture tax, right? That's an additional 25% tax. Now, I know you're saying, hey, what is that? How does that work, right? Well, the depreciation recapture tax works like this. Any depreciation that you've claimed in the property, the entire amount of depreciation for the entire time that you've owned the property, right? When you go to sell that property, they're going to hit you with a 25% depreciation recapture tax on that entire amount, right? Just on the depreciation alone, you're going to get hit with a 25% depreciation recapture tax, right? Now, on top of that, you may also be subject to what they refer to as the Medicare tax, right? That's an additional 3.8% tax. Now, how does that work? What's that all about, right? Well, the Medicare tax, that was passed back in 2010, with the Affordable Care Act, the Obamacare, right? It went into effect in 2013. It was one of the things that they passed to try to offset some of the cost of the Affordable Care Act. Cool. All right, so when you sell your real property, you may also be subject to that Medicare tax of 3.8%. Now, when you do a 1031 exchange, you can defer having to pay any of these taxes. All right. Now, what am I not listing up on the slide? I'm not listing anything to do with state income taxes, right? Because, hey, if you're located here in Florida like me, well, we don't have state income taxes, so we don't need to worry about it. But if we live in a state, or even if we're selling property in a state that has state income taxes, we would also be subject to state income taxes, all right? When you do a 1031 exchange, you can also avoid having to pay the state income taxes. Now, every state kind of has their own way of you completing some type of form or going through some type of process in order for you to get out of having to pay those state income taxes, all right? I'll give you guys a couple examples. We did an exchange for a gentleman. He was a Florida resident, all right, but he owned an investment property in California. Now, California has state income taxes. I think they have some of the highest state income taxes in the entire country. I think it can be as high as maybe like 12 or 13%. It's kind of like a tiered level. I guess the more you make, I think they hit you with a higher tax. But so even though he wasn't a California resident, he was a Florida resident, but because he was selling property in California, guess what? California still wanted their state income taxes, right? So what they made him do, because he was doing a 1031 exchange, to get out of having to pay the state income taxes, he was required to complete this form, the state of California form. You have to send it in, and that's how you get out of having to complete the state income taxes for California. Now, it's my understanding that he's got to complete that form every year thereafter. The year he doesn't complete that form, they come after him for the taxes. All right. Now, we did another exchange for a lady. She was another Florida resident. She was selling property in Maryland. Now, Maryland has state income taxes, right? So what they made her do to get out of having to pay the state income taxes is she had to complete this state of Maryland form. I think it was like 21 days prior to closing. We even had to sign off on it, and she had to submit that to the state of Maryland in order to get out of having to pay the state income taxes. So again, every state kind of has their own way of you completing some type of form or going through some type of process in order to get out of having to pay those state income taxes. All right. Now, for those of y'all that are on the line that are realtors, right, think about it. If that's your client and they're sitting there thinking they're going to have to pay all these federal income taxes, and if they live in a state that they have state income taxes, they're also going to have to pay state income taxes, it's a perfect opportunity for you to bring up 1031 exchange if they're not talking about it, right? Because the clients that live in states with state income taxes, it's even more worth their while to do a 1031 exchange because they can get out of having to pay that additional state income tax on top of the federal. All right. Now, how do you actually calculate what the taxes are? So, this is typically done by a CPA, but I'm going to walk y'all through just a real basic, quick example, just to kind of give you an idea of what potential taxes can be. All right. So, in our example, all right, originally we purchased the property for $500,000. Now, over the lifetime that we owned the property, we actually added back in $25,000 worth of capital improvements. Right now, we took some depreciation. All right, for the entire lifetime that we owned the property, we took $100,000 worth of depreciation. All right, now we're going to sell the property. We're going to sell it for $1 million. Right. So, in order to calculate what the taxes are, the first thing we need to do is we have to be able to calculate what they refer to as adjusted basis. Right. And basically, the way you do that is you take the original purchase price of $500,000, you add back in the capital improvements of $25,000, and then you deduct out the depreciation of $100,000, and that's going to give you an adjusted basis of $425,000. Right now, we're going to go ahead. We're going to sell the property for $1 million. Right, so you take that $1 million sales price, deduct out the adjusted basis of $425,000, and that's actually going to give us a gain of $575,000. Now, out of that number, how much of that was depreciation? $100,000, right? So we're going to take that $100,000 out of that number because the depreciation recapture tax, right, that 25% tax, that's actually calculated in a separate line item, right? So we'll take that $100,000 out, multiply it times the 25% depreciation recapture tax, and that's going to give us a tax of $25,000. Now, how much do we have left over since we took it out? $475,000, right? So let's just say we're at the highest capital gains tax rate of 20%. So we'll take that $475,000, multiply it times the 20% capital gains tax rate, and that's going to give us a tax of $95,000. All right. Now, let's also say we're going to be subject to the 3.8% Medicare tax. All right. So we'll take the $475,000, multiply it times the 3.8% Medicare tax, and that would give us a tax of $18,050. Right. So when we sell this property, we would be looking at a tax bill of $138,050. Right. When you do a 1031 exchange, you can defer having to pay any of these taxes. Right. Now, again, what am I not listing on this slide? Anything to do with state income taxes, right? So if we were selling a property in this state, or even if we lived in that state, we'd have to actually calculate those numbers as well, right? That would be an additional taxes, right? Now, again, realtors or even investors, if you're on the line, all right, realtors, if that's your client, right? And they're thinking, hey, they're going to have to cut a check for $138,050, and then whatever's left over, hey, now let's go out and find me some replacement property, right? Again, if you're the one that brings it to their attention, you say, hey, that check you're going to have to write for $138,050, do a 1031 exchange, defer all those taxes. Now let's go out and find you something even better, right? Because now if they don't have to cut that check for $138,050, they just have that much more to use to go out and buy a better property, right? Hopefully a higher dollar property, right? And hopefully it's going to give them more cash flow. It's going to be a higher income producing property. So everybody wins in that situation, right? The client's going to win, the seller, right? Because, hey, they save on the taxes, they get a better property, they make more money, right? You win as a realtor because why? Hey, you look like a rock star to the client, right? And hopefully you just increase your commissions because why? Because now if they can go out and purchase a higher dollar property, you just increase your commissions, right? Again, if they're selling a property in a state that has state income taxes, it's even more worth their while, right? Because that's an additional tax that they can get out of having to pay, all right? So some things to think about for everybody on the line today, right? Now, what are some of the tax advantages, excuse me, when you sell real property? All right, so with 1031 exchange, all right, let's review. All right, what type of real property can you do a 1031 exchange on? Any type of real property that you use in your trade or business or that you hold for investment, right? And it's a tax deferral. It's not a tax avoidance. We've already talked about that. Tax deferral meaning, hey, you may have to pay the taxes someday if you don't continue to do a 1031 exchange, but when you die, when you pass on, if you have any heirs that inherit your property, they're going to get that step up in basis, right? And hopefully no one ever has to pay the taxes, right? Now, what about your primary residence, your primary home? Can you do a 1031 exchange in your primary? And the answer is no, right? For your primary, you may qualify for what they refer to as a Section 121, all right? And the way the 121 works is you had to have lived in the property for at least 2 years as your primary, right? And when you go to sell your primary, if you have any gain, all right, and you're single, the first $250,000 of any gain is tax exempt, right? And if you're married, the first $500,000 is tax exempt. Now, tax exempt meaning that you never have to pay it, all right? It's not like a deferral with a 1031 where, hey, you might have to pay it someday. Basically, the 121 is one and done, all right? It's a tax exemption. You one and done. You never have to worry about paying those taxes again. All right. Now, you don't need anybody like me to help you with the 121. All right. It's just something you file on your tax return in the year that you sell your primary residence. All right. And how does I'll give you an example of how it works, how the 121 works. All right. Let's say back in 2010. All right, we buy our primary residential home, right, for $100,000. Right now. We're going to live in it as our primary for 5+ years, okay? And then in 2016, we're going to sell it. All right, now we're going to sell it for $1 million. Now I know everybody, that's a great deal, right? You bought it for $100,000, you're selling it for $1 million. I don't know if there's any properties like that anywhere here in the Tampa Bay area where I live, but I don't know. Maybe this is property in New York or California. Who knows? All right, but we'll keep the numbers really simple. All right, so. We're selling it for $1 million, right? We bought it for $100,000, so our gain's $900,000. Now I know that's not exactly how you calculate it, right? We have to figure out adjusted basis and everything else that we just talked about, but let's just keep it really simple, all right? So we have a $900,000 gain. Now, it qualifies for 121, right? Because we lived in it for at least 2 years as our primary, and let's say we're married when we sell the property in 2016, all right? So we're going to claim the 121, so the first $500,000 of the $900,000 gain can be tax exempt because we're claiming the 121 and we're married, right? But what's the problem? We still have another $400,000 worth of gain that we're going to be subject to taxes on. Well, that's going to equate to about $130,000 in taxes when we sell the property in 2016, right? Now, what if we could do this? What if in 2016 we could actually convert that property over to an investment property, a rental property, right? Let's say we rent the property out for 2 years, all right? So we're going to now sell it in 2018, all right? Well, now we're still going to sell it for $1 million. Let's keep all those numbers the same, but because now we're selling the property and it's an investment property, guess what? it qualifies for 1031 exchange. All right, we can actually do a combination of a 121 and a 1031. All right, the guidelines for that are you had to have owned the property for at least 5 years, you had to lived in it as your primary any 2 out of those 5 years. All right, so now when we go to sell the property, all right, we still have that $900,000 gain, so we're going to claim the 121, and the first 500,000 of the gain is going to be tax exempt. Now that additional 400,000 of gain, we're back in 2016, we're having to pay taxes on it, right? Now we're going to claim a 1031 exchange on that portion of the gain, that $400,000, and we're going to defer that portion of the tax by doing a 1031 exchange. So when we sell the property in 2018, we pay no taxes. All right. So I have a great PDF I'm going to send everybody out that explains this in more details. All right. So remember, I tell you all, I have a lot of the topics we're going to talk about today. I have in PDF form. I'm going to get them over to you. All right. So I get this question sometimes, with 1031 exchange, who can actually do a 1031 exchange? So, with exchanging, whoever the taxpayer is in the sale, okay, needs to be the same taxpayer in the purchase of the replacement property. So individuals can do 1031 exchanges, right? Husband and wives can do 1031 exchanges. Spouses can do 1031 exchanges. Now, sometimes we see this with spouses. Let's say one of the parties owns an investment property prior to being married, all right? Let's just say it's the wife, all right? So she owns an investment property prior to being married. Let's say it's a rental property, right? So she gets married, and then during the course of the marriage, she says, well, I'd like to sell this rental property, sell the investment property, right? I'd like to do a 1031 exchange because I want to defer the taxes. And the replacement property I want to buy, well, I want to go out and buy another investment property. That's going to be the new rental property. No problem, right? But in order to buy the new investment property, the new replacement property, she needs to get a loan, right? And in order to qualify for the loan, she has to bring her husband in because she needs his income to be able to qualify for that loan. Right? So how can you do that when you do a 1031 exchange, right? One possible solution would be this. You might be able to take ownership of the replacement property as what they refer to as tenants in common, right? So hopefully everybody knows what tenants in common ownership is, but if you don't, all right, basically the way it works is you can actually own a certain percentage of a property, right? Now, in order to do what I'm talking about, you have to get the lender's approval, right? Because what you can maybe do is you bring the wife in as a 99% tenant in common owner, and then maybe you bring the husband in and make him a 1% tenant in common owner. Again, if the lender would go for those terms, then hey, you can get the loan and you can move forward with buying that replacement property. All right, so that brings me to the next point. Tenant in common owners can do 1031 exchanges as well. I'll give you an example of how that can work. Let's say I want to go out and I want to buy an investment property, but I want to bring somebody else in with me to help me buy it. All right, help me purchase it. All right, and our intent is we're gonna purchase the property as tenant in common owners, where I'm gonna own 50% of the property and he's gonna own 50% of the property. Right, so we buy this investment property together as tenant in common owners, 50-50. Now we hold on to it for a period of years. It's an investment property, a rental property, right? And then at some point we say, okay, well, we're going to sell the property. Now, for me, I'd like to take my 50% tenant in common ownership. I'd like to do a 1031 exchange because, hey, I want to defer my taxes and I want to go out and buy another investment property. All right. Now, the other tenant in common owner, he says, you know what? I have no intent or no desire to buy any more investment properties. I'd like to just cash out and pay whatever taxes are due. I don't want to do a 1031 exchange. Well, he has that option, all right? I also have the option to do what I want to do. Hey, I want to do a 1031 exchange because I want to defer my taxes. I want to buy an investment property. I can do that, all right? Now, he could even do his own 1031 exchange if he chose to, if he wants to, and defer his taxes and go out and buy another investment property, okay? So tenant in common owners can do 1031 exchanges, right? Any type of legal entity that owns real property can do an exchange, okay? Corporations, partnerships, trust, LLCs. Okay, now sometimes we see this with LLCs where let's say you own a property in an LLC, and let's just say that that particular LLC, for tax purposes, is a disregarded entity. Now, we see disregarded entity, and maybe you have a single member LLC, right? And it's disregarded because for that particular LLC, you don't file a separate tax return for that LLC. Anything to do with that LLC, you just put on your personal taxes, all right? So that's referred to as a disregarded entity because that LLC and you as an individual are one and the same because it's all being reported under one tax return. All right. Now, sometimes we see this with 1031 exchanges. Somebody will own a property as an individual, all right, and when they sell the property in a 1031 exchange, the replacement property, they have the option to purchase the replacement property in their name as an individual or in their single member disregarded LLC. Because why? They can do that because they're considered one and the same for tax purposes, all right, because it's all being reported under one tax return. It works just the opposite way, too. Let's say you have a disregarded entity, a single member LLC that owns the real property, right? Sell that in a 1031 exchange. Well, the replacement property, you can purchase it in the name of the disregarded LLC, or you can even purchase it in the name of the individual because, again, for tax purposes, they're considered one and the same, all right? Now, sometimes we even see this with LLCs. Let's say somebody goes out and they're going to buy 1234 Main Street, right? It's going to be an investment property, right? So what do? Well, they go out and create 1234 Main Street LLC, right? It's going to be a disregarded entity, meaning that they're not going to file a separate tax return, right, for that LLC. Anything to do with it, they're going to put in their personal taxes, right? So they buy this investment property, 1234 Main Street, in the name of 1234 Main Street LLC. They hold on to it for a period of time, right? And then they go to sell it. And when they sell it, they do a 1031 exchange, right? Defer the taxes. And the replacement property that they buy, well, they're going to go out and buy 5678 Central Avenue. Well, guess what? They don't want 1234 Main Street LLC buying 5678 Central Avenue. So what do they do in that case? They go out and create 5678 Central Avenue LLC, right? That's also going to be a disregarded entity, meaning that what? They're not going to file a separate tax return for that LLC. Anything to do with that LLC, they're going to put in their personal taxes. Well, they can do that, right? Because all of those LLCs, those disregarded entities, are all considered one and the same with each other, and they're also considered one and the same with the individual. Because why? Because it's all being reported under one tax return. All right. Now, if it's a regarded entity, all right, where the entity files a separate tax return, maybe it's a partnership, corporation, whatever it may be, and the entity files a tax return, it issues K-1s to all the partners, okay? Well, if that entity sells the real property in a 1031 exchange, that same entity needs to be the purchaser in any replacement property or properties, right? If all of us on the line today, if we're all, let's say we're all in a partnership together, right, and we own a building, right? All right, and we sell that building in a 1031 exchange. Our partnership sells it. Well, the replacement property that we would purchase, right, the partnership would have to go out and purchase it, right? We could never try to go out and purchase property as individuals because why? Because we don't own the property. We didn't own the building, right? Our partnership does, right? So again, whoever the taxpayer is in the sale must be the same taxpayer in the purchase of any replacement property or properties when you do a 1031 exchange, okay? Now, property qualifications, right? What property is excluded from 1031 exchange? We already talked about what property can be used in a 1031 exchange, right? Any real property used in your trade or business so you hold for investment, right? Your primary residence is excluded. We talked about that, right? You can't do a 1031 exchange on your primary. What do you do for the primary? Well, it may qualify for that section 121, right? Now, property held for sale is excluded from 1031 exchange. I'll give you guys an example. Let's say I'm a builder. So here in the state of Florida, we have a lot of these like national home builders like Pulte Homes, KB Homes, Lennar Homes, okay? Let's say I'm Pulte Homes. Now, Pulte Homes, They're one of the largest single-family residential home builders in the entire country, right? They build new construction, newly constructed homes in multiple states, right? All over the United States. Now, the properties that they build, right? When those properties are completed, what do they do with them? Well, they turn around and sell them, right? Well, they can't do 1031 exchanges on those types of properties because why? Because they're holding those properties for sale and they're not holding them for investment. So you cannot do 1031 exchanges for property held for sale. All right. A dealer property is excluded from 1031 exchange. Now, what's dealer property, right? Well, dealer property might be somebody that we consider a flipper. You know, they come in, they buy a property. I don't know, 2 or 3 months goes by, they fix the property up during that 2 or 3 months, and then what do they do with it? Well, they turn around and sell it as well, right? Well, you can't do 1031 exchanges on those types of properties because they're considered a dealer. Like that's their inventory. That's the business that they're in, right? They fix properties up, and what do? They turn around and sell them. Well, you can't do 1031 exchanges on those types of properties. Now, what if I'm a flipper? Here's an example. Let's say I buy a property. 2 or 3 months goes by, all right, I fix it up, and then instead of turning around and selling it, they go to their realtor and they say, hey, can you put this in the MLS system showing it for rent at fair market value? That's a little bit different, right? Because now all of a sudden what just happened? They're showing their intent that they're holding it for investment and they're not holding it for sale, right? Hey, who knows? Maybe they even show it to a potential renter, right? They run some type of credit check on that potential renter. Maybe the potential renter has horrible credit and they decide, hey, I'm not even going to rent it to that person, all right? If they get audited, if that flipper gets audited and the IRS comes in and says, hey, prove to us you held that property for investment and not for sale, they're going to have to be able to back it up. All right. In the example I just gave you guys, hey, they might be able to back it up. They have a pretty good chance because, look, they could say, look, here's an email I sent to my realtor asking the realtor to put the property in the MLS system showing it for fair market value rent. Hey, here's the MLS listing showing it for rent at fair market value rent. Here's the day I showed it to that potential renter. Hey, here's the credit report I ran on that potential renter. All of that type of stuff, right, is going to be their backup, their ammunition, their trail of breadcrumbs, all right, to prove that they held that property for investment and not for sale, all right? But if they just strictly come in, fix the property up, you know, again, 2 or 3 months, however long it takes them, and then they turn around and sell it, well, you can't do a 1031 exchange on that type of property, all right? Now, foreign property is excluded from 1031 exchange. Now, this might be pretty obvious, but I couldn't sell a property here in Florida in a 1031 exchange and then try to buy replacement property somewhere in Canada or Mexico or somewhere in Europe. Okay, it has to be what? It has to be domestically located property, including Guam or the U.S. Virgin Islands. All right, so foreign property is excluded from 1031 exchange. Okay. Now, the tax deferral requirements. All right, so in order to get a full deferral, to defer your taxes 100%, right, rule number 1 is you must reinvest all the net proceeds in property of equal or greater value. Now, what exactly does that mean? What are the net proceeds? Well, net proceeds, that's the cash, all right? That's the cash that normally you would get out of the closing. Now, we're the qualified intermediary, the QI. We're going to hold the proceeds from the sale on behalf of the seller, the exchanger, okay? Because the rule is you can never actually have receipt of the funds. If you do, you lose your ability to do a 1031 exchange, all right? So you can't close today and call me tomorrow and say, hey, Jeff, I want to do a 1031 exchange. At that point, it's too late, all right? You can even close today and get in the parking lot, all right, at the escrow company, title company, the attorney's office, right where you just did the closing, all right? It might be sitting in their escrow account waiting to wire the funds out to you. You've lost your ability to do a 1031 exchange because in that case, you have what's referred to as constructive receipt, all right? You have a legal right to the funds. You've lost your ability to do a 1031 exchange, all right? So we have to get involved prior to the sale happening, prior to you walking out the door. Right? We're going to hold the proceeds from the sale, right? And what's the rule? You have to take that entire amount, right? And you have to go out and you have to buy a replacement property, or it can even be a combination of properties where the purchase price or the combined purchase prices are at least equal to or greater than whatever the sales price was on the property that you sold, the relinquished property. All right, that's rule number one. Rule number two is you must acquire an equal amount or greater debt in any replacement property or properties. Now, what exactly does that mean, right? Debt. If you have a loan that you're paying off, right, you're required to get a loan of at least that amount or greater in the purchase of any replacement property or properties. Now, that rule can actually have an exception, all right? If you have cash that you can add to the purchase of the replacement property, you can offset having to acquire any debt or any additional debt. All right. Now, if you don't have a loan that you're paying off, well, you're not required to get a loan when you purchase your replacement property, but you do have the option. All right. If you need to get a loan or you want to get a loan to help you purchase the replacement property, you do have the option to be able to do that. All right. Now, how do the numbers work? All right, so in our example, all right, we're going to sell our relinquished property for $1 million. All right, now we have a loan that we're going to be paying off. All right, we have debt of $300,000. That's the payoff amount. So we'll take that $1 million sales price, deduct out the $300,000 for the payoff for the debt. All right. Now we have a cost of sales of $50,000. That cost of sales, that's like real estate commissions, closing fees, title insurance, right? Some of those non-reoccurring type of fees, costs associated with the closing. Let's say that's $50,000, so we'll deduct that out, and that's going to give us net proceeds of $650,000. Now, again, we're the qualified intermediary. We're going to hold that $650,000 on behalf of the seller, the exchanger, right? And what are they going to do with those funds? Well, in this example, they're going to take that entire amount, that $650,000, and they're going to go out and they're going to buy a replacement property greater in value. They're going to buy a replacement property for $1.2 million, right? So they just met rule number one because why? They used the entire net proceeds towards buying a replacement property for $1.2 million. Right, so they still need another $550,000 to help them buy that replacement property for $1.2 million. So what do they do in that case? Well, they go out and they get a loan for $550,000. Right, by doing that, they actually just meet rule number two because why? Well, they had a loan that they paid off for $300,000, and they actually acquired greater debt because they got a new loan for $550,000. So in this example, they would get a full deferral. They could defer their taxes 100%. Right now, what if they wanted to do this? What if out of the $650,000 they say, well, we don't want to use all of that towards buying the replacement property. All right, we only want to use $550,000 of the $650,000 to help us buy the replacement property. We want to hold back $100,000. We want to put that in our pocket. All right, they can do that as well. All right, but that $100,000 that they hold back, that they put in their pocket, they're going to be subject to taxes on that amount. All right, it's referred to as cash boot. All right, hey, it doesn't mean they can't do a 1031 exchange. All right, it just means that instead of getting a full deferral, they're going to get what's referred to as a partial deferral. Now, partial, why? Because they're going to be paying some taxes on the boot, on that cash boot. All right, now that $100,000, they can do whatever they want with those funds. Right, they want to pay off bills. They want to go on a great vacation. I don't know. They have a child starting college. They want to pay for college. Hey, who knows? Maybe they want to go to Vegas. They want to blow it all gambling. All right, whatever they want to do with that $100,000, they can do. All right, but again, they're going to be subject to taxes on that amount. All right, now back to the example. So the $550,000, and that's what we're going to hold on behalf of the seller, the exchanger. And in this example, they're going to take that entire amount, that $550,000, and they're actually going to go down in value. They're going to only buy a property for $800,000. Okay. Now, they still need another $250,000 to help them purchase that property for $800,000. So what do? Well, they go out and get a loan for $250,000. But by only getting a loan of $250,000, they actually go down in debt by $50,000. Because why? Because, hey, they had a loan that they paid off for $300,000, and they actually acquired less debt, $50,000 less debt. Now that $50,000, they're going to be subject to taxes on that amount. All right, that's referred to as mortgage boot. All right, so there's two types of boot. There's mortgage boot and there's cash boot. Again, it doesn't mean that you can't do a 1031 exchange. It just means that, hey, you're going to get a partial deferral instead of a full deferral. All right. Typically, the taxes, the tax that you pay on the boot is going to be less than if you just sold the property outright and you did not do a 1031 exchange. Right. If anybody ever wants to do anything like this, I always tell them and say, look, talk to your CPA. Right. Make sure you know all of your numbers. Right. Because you have to look at it and say, okay, if I don't do a 1031 exchange, if I just sell the property outright, well, what's my taxes look like? But if I do a 1031 exchange, but I take out some boot, I pay taxes on the boot, well, what's my taxes look like if I pay tax on the boot? Again, typically that tax is going to be lower than if you just sold the property outright. But if that tax happens to be greater than if you sold the property outright, guess what? Don't do a 1031 exchange, okay? Because it's not going to be worth your while. You're actually going to lose money, all right? So again, always talk to your CPA. Make sure you know your numbers before you do anything, okay? Now, there's some timelines everybody needs to be aware of, all right? So for when you sell your relinquished property, okay, you're going to have 180 calendar days to purchase any replacement property or properties, all right? Now, it's actually 180 calendar days or the date you're required to file your tax return with extensions, right? With extensions, meaning that if you're required to file your tax return on April 15th, all right, you could possibly have less than 180 days to complete your exchange, right? But if you file an extension where you don't have to file your tax return on April 15th, you can get the full benefit. Like, let's just say you close today, right? Today is what? Today's December 8th, right? Well, April 15th is less than 180 days away, right? So you would actually have less than 180. But if you file an extension where you can, you don't have to file your tax return on April 15th, you can get the full 180, all right? And it's 180 calendar days. That's holidays. That's weekends, okay? Here in Florida, we're subject to hurricanes. We just ended November. It just ended. But if we're getting hit with a hurricane and everything's shutting down for a day or two or a week, it does not matter, all right? So it's a total of 180 days to complete your exchange, to purchase any replacement property or properties. The first 45 days of the 180, they refer to that as the identification period, all right? What exactly is that? Well, the identification period is you must identify any potential property or properties that you want to buy. All right, now that's something else we're going to assist with. We're going to provide a form to the client, the exchanger. It's called the Identification ID Letter. And on that form, there's going to be some blank lines, all right? It's going to have to be specific to a property address or addresses, all right? Client, the exchanger is going to have to fill it out, sign off on it, get it back to us by midnight of the 45th day. That's how they will formally identify their replacement property or properties. They do it to us, the qualified intermediary. None of those properties even have to be under contract, right? You just have to identify any potential properties that you want to buy. But here's the thing, okay? Let's say you find the perfect property on day 46. At that point, it's too late. All right, so whatever you put on that form, you're going to have to make sure you're going to be able to buy at least one of those properties. If for some reason you're unable to purchase any of those properties, all right, by day 180, unfortunately, you're going to be paying all your taxes. All right, if you're purchasing one of those properties on day 181, it's too late. You're paying all your taxes. If you do not identify any replacement properties by midnight of the 45th day, on day 46, you're paying all your taxes. All right, so it's very specific to 180 days to purchase your replacement properties, and you must identify by midnight of the 45th day any potential replacement property or properties, and you must be able to purchase at least one of those. Okay? Now, there are some identification rules as far as what you can identify. Now, there's three different rules, okay? I'm going to read each one of the rules individually, and if you don't quite understand them when I read them to you, don't worry about it, because I'm going to walk you through some examples of how the numbers work for each one of the rules, and hopefully, once you see how the numbers work, it'll make sense for you. All right, so the most popular rule that we see, probably 90 to 95% of all the exchanges we do fall under this first rule, all right? It's referred to as the three property rule. And the three property rule states that you can identify up to three properties without regard to the fair market value of those three properties. Now, what exactly does that mean, right? Well, if you identify three properties or less, the purchase prices can be any dollar amount. It does not matter as long as it's three properties or less, all right? Now, if you want to identify more than three properties, you can do that, but you're going to fall into this next rule. It's referred to as the 200% rule, right? And the 200% rule states that you can identify over three properties, but you cannot exceed 200% or two times the combined fair market value of the property being sold. So what exactly does that mean, right? Well, if you identify more than three properties, the combined purchase prices of all those properties that you've identified cannot exceed 200% or two times whatever the sales price was on the property that you sold. All right. Now, if you want to identify more than three, you want to exceed the 200% rule, well, you can do that, but you're going to fall under this next rule. It's referred to as the 95% rule. Now, it's very rare that we even see this rule enacted. All right. It's not even talked about a lot it's not even mentioned in any of the literature that we produce that sit in real estate offices or title companies, escrow offices, but it does exist. All right, I want everybody to make sure that you're aware of it, because it doesn't make a lot of sense, honestly. All right, but remember, hey, it's the IRS. Some of this stuff just doesn't make sense sometimes, right? Because it reads like this. You can identify over three properties. You can exceed the 200% rule, but you must acquire at least 95% of the value of all the properties that you identified. Now, I know that's probably about as clear as mud, all right? Let me show you all the examples, especially with this last one. Hopefully you'll understand it a little bit better when I show you the example for the 95% rule. All right, so here's the three property rule. Again, if you identify three properties or less, they can be any dollar amount. It doesn't matter. The purchase price can be any dollar amount. All right, so here's an example. We sell our property for $1 million. We go out and we identify three properties, all right, because we identified three. We're in the three property rule. Let's keep the numbers simple. Let's just say we're going to buy each one of them for $1 million each. All right, so we've identified how much in property? $3 million worth of property, right? Now, we could be buying each one of those properties for $10 million a piece for a total of $30 million in identification. Again, with the three property rule, they can be any dollar amount. It doesn't matter, all right? What does matter? And I'll say it again, all right? If you identify three properties, boy, you better make sure you're going to be able to buy at least one of those properties, all right? So what's the best way to lock up a property? Is to put one of them under contract, right? So that's typically what we see. You're not required to put one under contract, but typically somebody will put a property under contract. That's one of the properties they identify. Then I don't know, maybe they'll identify two other properties that obviously are not under contract, because again, if after midnight of the 45th day, let's just say the property you have that contract on, if that whole thing falls apart, well, at least you would have the opportunity to purchase those other two properties that you would have identified on the form that you turned in by midnight of the 45th day. All right, so that's the three property rule. Now, here's the 200% rule. Again, this is where you exceed the three property rule, but then you cannot exceed 200% or two times whatever the sales price was on the property that you sold. All right, so here's how it works. Again, we sell for $1 million. Now, this time, we actually go out and we identify five properties, all right? Because we've identified five, what just happened? Well, we've exceeded the three property rule, right? So that puts us into the 200% rule. So what does that mean? Well, what that means is the combined purchase prices of all five of those properties cannot exceed $2 million. Now, you might be asking yourself, well, where are they getting the $2 million from? Well, we sold for $1 million, right? 200% of $1 million that we sold, or two times the $1 million sales price that we sold for, is how much? $2 million, all right? So that's where the $2 million is coming in. I think that one's pretty straightforward. Now, here's the 95% rule. Again, this is where you exceed the 3-property rule, you exceed the 200% rule, but you must acquire at least 95% of the value of all the properties that you identified. So here's how it works. Again, we sell for $1 million. Now, in this case, we go out and we identify 10 properties, all right? Because we've identified 10, what just happened? We exceeded our 3-property rule, right? Now, let's keep the numbers simple, all right? The purchase prices. Let's say we're going to buy each one of them for $1 million each. So we've identified how much in property? $10 million worth of property, right? Because we've identified $10 million worth of property, what just happened? We've exceeded our 200% rule because that was how much? $2 million, right? So that puts us into this 95% rule. So in our example, all right, if we only acquire 9 out of the 10 properties, that's only 90% or $9 million. That's not 95%, right? All right, if we do that, if we only acquire 9 out of the 10 properties, guess what happens? We actually blow our entire exchange and we have to pay all of the taxes, right? So the reality of the 95% rule is really 100%, right? And whatever you identify, you're going to have to buy, right? And we're using really simple numbers. We're saying, hey, the purchase prices are going to be an even $1 million. You know what? Those purchase prices are going to be all over the map, right? It's going to be really hard to sit down and say, okay, let's see, if I get this property, wait, that only puts me at 93%. Maybe I need to make sure I purchase this other property. Wait, that's only going to put me at 94%, all right? 95% rule is 100%, is really 100%, all right? The IRS, they want to limit you on how many properties you can identify, all right? They don't want you identifying everything under the sun because you know what's going to happen? If you identify everything under the sun, you're going to have to purchase everything under the sun, all right, because of this crazy 95% rule. All right, hopefully everybody gets that one. If not, hey, we can talk offline. Maybe we can go through a different example. All right, now, everything we talked about today, at least up until this point, is referred to as a delayed exchange, all right? It's actually where you sell first. You're selling your relinquished properties first. You're identifying replacement property by midnight of the 45th day, and you're buying last, all right? You're buying your replacement property by day 180, all right? That's referred to as a delayed exchange, most common exchange that we do. But there's a few other types of exchanges, all right? There's one that's referred to as a reverse exchange. Now, it works just the opposite of a delayed exchange. It's actually where you buy first. You're buying your replacement property first, and then you're selling your relinquished property last, all right? Now, they can work something like this. Let's say you have your property listed for sale, right? Now, you go out, maybe you don't even have a contract on it yet, right? But you go out and you find the perfect replacement property, all right? And let's just say it's a seller's market, all right, like we have right now, okay? Seller's market. Properties are turning over really fast, all right? And you know, boy, if you don't act fast, you're going to lose out on being able to buy this perfect replacement property. Because what? Because it might get sold, right, before you sell your relinquished property. So, gosh, what can you do, right? Well, you can do this thing called the reverse exchange, right? The way the reverse exchange works is we actually come in and we form a separate company, an LLC. It's also referred to as an exchange accommodating title holder, EAT for short. All right, and we come in and we purchase the replacement property before you sell your relinquished property. All right, when we do that, when we purchase that replacement property, you must be able to sell your relinquished property within 180 days. All right, so there's the 180 coming back into play. It never leaves. All right, it's always going to be there. All right. What are some of the advantages for a reverse exchange? All right, as I mentioned, seller's market like we have right now. You need to act fast. You can save the whole deal. You can get that replacement property before it gets sold, right? What if you did this? Some of y'all that are realtors on the line, you may have experienced this with clients in the past. They list their property with you, right? And they think, gosh, my property is the greatest property in the world. I'm not going to have any problems selling it. So what do? They go out and put a contract on a replacement property, right? And then slowly but surely, what happens? Reality sets in, right? And they start to realize, gosh, maybe I don't have the world's greatest property because I'm not getting all those showings like I thought I was going to get. I'm not even getting all those offers like I thought I was going to get. But guess what? They've already put a contract in on a replacement property, and that closing date is fast approaching. Okay, they're obligated to buy that property. What can they do? Well, they can save the whole deal and do a reverse exchange. Now, the biggest negative, the biggest obstacle to overcome in a reverse exchange is the financial part. All right, hey, we're a great company, but we're not just going to come out of pocket and buy the replacement property, all right? The seller, the exchanger, okay, is going to need to be able to give us the financing to be able to do that, all right? Typically, it's going to have to be cash. Now, why do I say cash? Because if they're dealing with a conventional lender or traditional lender, lenders are not going to loan funds at that point, all right? We're not the borrower, the exchanger is, all right? We're going on title, they aren't, all right? Typically, lenders aren't going to loan funds at that point. That's why I say they're going to need to be able to give us the cash to be able to do that. Now, hey, maybe they have some type of great banking relationship, right? They can get some type of line of credit, something like that. Some people tell me some of these hard money type of lenders, hey, they'll do deals like that all day long. For us, it doesn't really matter. Just some way, somehow, they have to be able to give us the financing to be able to purchase the replacement property. All right. What's the other negative? What's the other drawback? Hey, you have to be able to sell your relinquished property within 180 days. Okay. What happens if you don't sell it within 180 days? Well, you're going to own two properties. We're not going to hold on to it because on day 181, we're transferring it over to you. You're going to own two properties. All right. Now, if ultimately you say, well, I still want to sell that investment property, hey, you can do that. All right. No problem. But you're going to have to pick a new replacement property, right? Because the original replacement property you would already have owned, all right? And with 1031 exchange, you can't exchange it to something you already own, all right? So that's how the reverse exchange works. Now, there's another type of exchange referred to as a construction exchange. Another term you may hear people refer to it is a built-to-suit exchange, an improvement exchange, all right? They can work something like this. Let's say you sell your relinquished property, all right? You sell it in a 1031 exchange, and we're the qualified intermediary, right? We're going to be holding the proceeds from the sale. You go out and you find a replacement property, but hey, it's not everything you want. You want to do some improvements to it before you actually purchase it. So, hey, we can come in again. We form that EAT, that exchange accommodation title holder. We can use the proceeds from the sale, and we come in and buy the replacement property, all right? And then we oversee any construction, any improvements to the property, all right? We're working with the contractors. We're handling disbursements, paying those contractors. Now, the exchanger is right there, letting us know, with their guidance, hey, this has just been completed. We need to cut a check or pay this particular vendor, subcontractor, contractor, whatever it may be, all right? Now, those improvements need to be done. Does anybody guess? I'm sure you're guessing out loud. 180 days, all right? There's that 180 coming back into play again. Again, it never leaves. It's always going to be there, all right? So that's referred to as a construction improvement built-to-suit exchange, all right? All right, so what's our fee? What do we charge for our services, right? Well, that delayed exchange, right? Again, the most common type of exchange, it's actually where you sell first, right? You sell your relinquished property first, 45 days to identify, and you're purchasing your replacement property last. You're purchasing that replacement property by day 180, all right? We charge $750 on the sale. We don't collect anything until it physically closes, all right? So typically, we start doing our thing once a contract gets signed. We get all the documents prepared for the exchange that set the exchange up. It's referred to as the exchange agreement. We send that to whoever's going to be handling the closing, escrow company, title company, attorney. Those documents are sitting there waiting for the closing to happen. When the closing happens, the day of closing, that's when we charge the $750. If for some reason it never gets to closing, if the contract falls apart, file cancels, all right, we don't charge any kind of cancellation fees, all right? We don't charge any type of wiring fees, anything like that, all right? We charge the $750 the day of closing. If you're a realtor, we're just like you guys. You don't earn your commission until it closes, right? Neither do we. All right, so we charge $750 on the sale, and then when you purchase your replacement property, we charge $250. Right, so if you sell one property, you buy one property, our total fee is $1,000. That's it. There's no other hidden fees, no other costs associated with it. Now, if you buy a second property, it's a second closing, a second set of documents we need to prepare for the replacement property. It's another company that we're dealing with for the closing. It's another $250. So, all right. So, but typically, if you sell one, you buy one. That's it. it's $1,000. Now, the reverse exchanges, construction, improvement, built-to-suit exchanges, all right, those can be extremely more complicated, right, than the delayed exchange. We're forming a separate company. We're going untitled. With the construction, improvement, built-to-suit exchanges, hey, we're working with contractors, right? We're handling dispersing, paying the contractors, right? Those types of exchanges, both of them, start off at about $6,500, right? In the very beginning, I mentioned to you guys, one of our owners of the company is a tax attorney, Adam Skarsgård. Adam personally handles any type of reverse exchanges that we do, construction, improvement, built-to-suit exchanges, because they can be so complex, right? He looks at each one of them individually and determines what the how complex they are, how much work they're going to be, and bases our fee off of those, right? Off of that. And again, they start off at $6,500. All right. All right, we're good on time. We got a few minutes left. We got 9 minutes left? So no, 12:15. So 4 minutes left. So I'll open the floor up to questions. All right. Again, right-hand side, there's a box that says questions. Feel free to type your questions in. And while we're waiting, I'll mention this again to everybody. A few people joined late. Today's presentation was recorded. All right. You're going to receive a link with the recording of today's presentation if you want to refer back to any of the topics. A lot of the topics we talked about today, I have in PDF form. I'm going to email those out to you guys. All right. If you're a realtor and you want to forward those on to clients, great. All right. If you're an individual investor, great. You'll have them at your disposal. Don't feel like you have to be a 1031 exchange expert by any means. All right. I talk to people all day long about 1031 exchange. I'd be glad to talk to your clients. I'd be glad to talk to you individually. If you're an investor, just let me know. My phone number is up on the screen. My email is up on the screen as well. All right. Some of the PDFs I have in Chinese, and I even have them in Spanish. If you'd like to have the other languages, please shoot me an email and let me know. All right. Also, those on the line that are realtors, or even if you're with an escrow company, title company, I do a lot of individual classes for various real estate offices, boards of realtors, title companies, CPA firms, attorneys' offices. If you think the other realtors or staff members in your office would benefit from me doing an individual class for your individual office, let me know. All right. I have the basics class. That's an hour-long class. We did that one last week. I have this class, the advanced class. It's about an hour and 15 minutes. Okay, y'all just sat through this one. And for Florida realtors, okay, I have a 2-hour continuing ed class. Now anybody can attend it, but and I'll do it for anybody in any state. But if you're a Florida realtor, you'll get 2 hours of continuing ed. All right. Let me know if you'll want me to do that for you. Shoot me an email. I have some PDFs. I can send out information about the various classes that I teach. If you want to forward it onto your broker or the owner of the office, manager, whatever it may be. All right. Let me know, and I'd be glad to set something up with your individual offices. All right. Next week, I have another class coming up. Next Tuesday on the 15th. It's that 2-hour continuing ed class for Florida realtors. It's from 11 to 1. It's going to be on Tuesday, again, December 15th. You want to pick up 2 hours of continuing ed? You have other people in your office, pick up the 2 hours of continuing ed. If you're not a realtor and you want to attend it, you have somebody else you think would benefit. It's kind of a combination of this class and the basics class plus additional information. So just let me know if you received the information about this class. You should have received the registration for the next week's class as well. If not, let me know. I'll get it over to you. All right. Questions? Wow. Doesn't look like there's any questions coming in. So hopefully I must have done a pretty good job today. But if you do have a question after we hang up, hey, again, feel free to shoot me an email, give me a call. We can talk. Some people are like, well, my question's kind of complicated. I can't type it in 30 seconds. No problem. Let's talk. Again, I talk to people about 1031 exchange all day long. All right. I'd love to be a resource for you, for your clients. Just let me know. All right. So I guess we'll go ahead and wrap it up. We have 1 minute to spare. Again, if y'all want to register for the class next week, feel free. It's on the 15th, Tuesday from 11 to 1. That's Eastern time, but anybody can attend. If you're a Florida realtor, You'll get 2 hours of continuing ed. You'll have to register again like you registered for this class. If you want the continuing ed, make sure you have your real estate number with you when you register. It either starts off with a BK if you're a broker, or SL if you're a salesperson, just a regular a non-broker. I need both. I need the letter and the number because I have to submit that to the state of Florida to get you continuing ed. All right. So thanks, guys. Thanks for hanging in there with me today. Again, hopefully you learned a little bit something. If I can do anything for you in the future, please let me know. All right. Stay safe, everybody. Stay healthy, and happy holidays to you. Thanks for attending today. Hopefully we'll talk soon. Thank you. Bye-bye.